Happiest minds in focus. The tech service providers announced its first quarter numbers yesterday. Profit has risen on the back of better margins. Top line, though, remained flat. We spoke with the management. Listen in.
Firstly, a lot of changes, a lot of transformation that has happened in terms of structure as well as from a business strategy perspective as well. And it seems that it's percolating in terms of the numbers. If you have to talk about the first quarter, what has led to this kind of an uptick in terms of profitability as well as margins?
So taking that question, we have shown a solid growth of about 2.3% in constant currency and about 18% year over year. That's in revenues, while operating margin has grown by 20% on a sequential basis and about 6% year over year. So why I highlight these two is to show you that or talk about the strong margin performance and the organic growth rate that we have put forth for this quarter. The revenue growth is quite in line with the double-digit revenue estimate expectation for us that we have put out late last year at the end of last quarter. When we talked about results, we are looking to have a double-digit growth in constant currency, and this is a good start to that target. As far as margins are concerned, we did have a drop in the last quarter, but we are back to our 17.8% kind of a trajectory that we showed throughout the last year. And our EBITDA is back in the range of 20 to 22%, which is again the estimate that we had given to the street. So all in all, it's a good performance. But the highlight here I would want to draw your attention to is that our generative AI business services, into which we have been making investments for the last 5 to 6 quarters, has broken even on an operational basis or on a contribution basis this quarter. It's a small profit of 24 lakhs, but nevertheless, that shows the strength of the franchise and the focus that we are having in that business. Until now, many of the projects were POC, but now we are seeing that turning into revenue generating long-term, larger value contracts, and that's quite heartening. So it's a step in the right direction, and Joseph will give you a brief, or he'll talk about a transformational agenda which underpins all of this performance.
One interesting question that comes up over here, Venkat, is your FY27 EBITDA margin target of 20 to 22%. Does this tell you that you're on track with the way the first quarter performance has been so far?
That's right. 20 to 22%. We don't call it a guidance because,
okay.
We are still holding on to that number given all the happenings in the world. But that's a number that we are targeting to achieve. And if you look at the first quarter at 21.4, we are pretty much within that range. And like I said, contributions from generative AI business services and the new sales engine that we put in place, both of which were investments in the last 4 to 5 quarters, is now starting to bear dividends.
Okay, we'll talk about the Gen AI business as well, but the other aspect I want to consider is in terms of the $1 billion target by FY31. The expectation was that taking, the shift that we are seeing in terms of the macroeconomic environment, the Trump-related unpredictability, there could potentially be a revisit to that number of $1 billion by FY31, and this could probably be given in the first quarter of FY26. Is there any revision to achieve this milestone, or do you think nothing can actually change that?
It's actually part of our vision statement to touch $1 billion. As of now, we are not revising it, but we are constantly, relooking at the ways and means to achieve it organically and inorganically, as the case may be. But it's a vision statement, and we'll relook at it. We said that we put that out in FY21, and we are on target to meet many of the other aspects of the vision statement. There are about 10 points that we have set out for ourselves in the vision statement, and we are targeting to move on those fronts, but at the same time not losing track of the 1 billion target and seeing how to achieve that. And you've got another five years out there for us to do that.
Yeah, and Venkat, that would require almost a 22 to 23% CAGR growth, with a significant portion that could probably be driven by inorganic growth as well. So does that combination fit well?
We have done 28.5% CAGR growth in constant currency from FY21. So, it does tell you that it's possible to do that. And yeah, rightfully so, that growth is a combination of both organic and inorganic. And if you act on a similar course of action, I'm not we are okay in terms of achieving that vision or a milestone that we have set for ourselves. Yes, but we'll evaluate that constantly as we move forward and come closer to the time.